AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
Welcome to the last show of 2021.
Could you believe it? One more show. This is it.
This is it. Minus, 40, 50 minutes.
Yeah, absolutely.
It's been a very interesting year. Last couple of years. We're still right in the middle of COVID. We're seeing another surge in cases around the United States. How does that play into real estate and interest rates? It does in many ways, especially with inflation looming around the corner. We're going to talk about that today as investors are fearing inflation the most in 2022, and they see the stock market returns a little bit lower, according to a CNBC survey. Mortgage rates continue to be the kind of right there in the front of buyers and owners. 3.11% on the 30-year fixed, according to Freddie Mac weekly survey, and 2.33% on the 15-year. That hasn't moved that much, the 15-year, but the 30-year has definitely moved. It wasn't too long ago, Gordon, that we saw it under 3%.
Absolutely. 30-year fix has been the gem of the mortgage business for the last 3 years. For the most part, everyone that calls us looking to refinance, looking to make a purchase, the benchmark is a 30-year fix, and the 30-year fix has outperformed any other pricing on the market that you can figure as far as a product is concerned. A lot of times people talk about ARMs, they talk about the midterm ARMs, the 5-year, the 7-year, the 10-year, but those loans over the last 3 years have not outpaced or outperformed the 30-year fix. So that's the reason why that's the benchmark. That's the bread and butter of our business is probably a good way to sum it up.
We don't really need to talk about ARMs, but when do we start talking about ARMs? Right now, the 5-year is at 2.41%, and kind of the rule of thumb is as 30-year fixed rate starts going up, it's a little bit more attractive to go into those ARMs. But we've seen ARM usage fall off significantly coming out of the Great Recession, and to very low double-digit usage. I think, what is it, like 12%, 13%? At one point, I remember in the Bay Area, ARMs were the predominant product in the market at 72 or 73% usage for every transaction that was going on in the Bay Area, refinance and purchases. And now we're down to like 10 to 12%. When do we start talking about that again as we see interest rates rise? Or do you think it won't get there because some of the projections are only 3.6% on the 30-year fixed? Is that enough to start looking at an ARM that you can get, in this case, 7/10 lower?
Not quite yet. We're not quite in the arms race yet, I would like to say. If you go back and look at rates, if you look at adjustables, look at 1-year ARMs, monthly ARMs that adjust monthly. People are afraid of those because most people are afraid of the possibility of them actually going up. Adjustables do outperform fixed rates in the long run when you look at the ins and outs of the marketplace. But of course, no adjustable is going to outperform its 2.5% 30-year fixed rate product. So when you look at the overall scheme of things, you have to look at your age. What is your goals, especially how long you plan on staying in the property. All those things you can factor in to make a very informed decision of which actually product can actually benefit you in the real estate mortgage interest market. Especially now, as we talk on the show all the time, there are many, many tools out there on the internet. You can go and plug in numbers, compare ARMs to fixes, compare 5-year, 7-year, 10-year, how long you plan to stay there, and actually kind of come up with a winning hand. Which product would be best for you under the circumstance, provided you follow the plan that you submit in your scenario.
And for those who don't know what a 5-1 ARM means, it means that it's fixed for 5 years, and then for every year after that, the 26th year the 6th year and so on, it adjusts every year to whatever index it's tied to. So a lot of people like that fixed period because you can get it, in this case, 7/10 lower than a 30-year fixed. If I'm going to move in 5 years, why am I tied to a 30-year? And a lot of people, believe it or not, still get the 30-year fixed, even though they could save money. But we're going to see a lot more people in the higher loan limits, the higher range, $1 million plus, use a lot more ARMs. That is definitely where we see more ARM usage because a 7/10 decrease in rate on $1 million loan is a significant amount in monthly payment difference.
It's just like we're talking to a few clients that are calling, some of these clients are in their early 60s, to mid 70s. and we're talking 30-year fixes versus 15. A lot of people are concerned about they don't want the long-term rate. And I'm saying, well, listen, at this stage of your life, if you look at where you are, how much you owe in a house, possibly of paying it off, it's not really, it's a moot point, especially if it's your primary residence and you can actually afford the payment. You know, why stress yourself going to a 15-year loan at 60 years old, trying to get the loan paid off by the time you're 75, versus if you were 40, it would make a huge difference. But a lot of times, is we play the odds. We play what people tell us, what our friends are doing, what our neighbors are doing. Sometimes people take that as the advice or the rule of gold rather than actually research it and figure out what's best for them. So a lot of times that's why they call us, so we counsel them and kind of figure out what's best for you under our recommendation. But at the end of the day, it's you, the consumer, that has to make the decision that's going to benefit you in the long run.
Here's a little quiz for you, Gordon. Since you have to take your testing every year, where did the ARMs come from? Who were the first entities to use the ARMs?
I think it was the United States government.
It was the savings and loans. Do you remember?
Yeah, absolutely.
That was because when they were loaning money based on deposits, and then they would have that margin that they would profit from, and then when the interest rates skyrocketed in the 80s, they were stuck with all of these loans that they weren't making money on because they still had to pay the depositor a certain amount of money, but they weren't getting the same back from those 30-year fixed. Right. So they negotiated with the entity at the time, the government entity, to turn around and say, you know what, let's do an ARM. It'll fluctuate with interest rates as they go up and down. So that's kind of the idea behind ARMs, is that lenders will make that margin no matter what, and it's based off an index. Now, we just recently saw the LIBOR, poof, gone. And now we're using...
I forget the index.
It's not the coffee.
LIBOR.
It just changed.
But it's been on the radar for a long time. They're going to wipe out the earner. Just like a few years ago, we wiped out the index, the 11th district cost of funds. We went to what they call a COSI, which is the cost of savings loan, CODI, cost of deposit loan. Many different indexes that we have to come up with in order to substitute the index if no longer available. And of course, the most common, I think, is the Treasury, because that's always been consistently available. So a lot of times, there's a lot of those indexes. If you read your fine print, what happens if your index goes away? It defaults to one of those other indexes. So you just don't get a free loan as you think because the index went away.
I just pay the margin.
Yeah.
But that margin is what the banks make, and it's easier to sell something, when you know how much you're going to make based on that index. But it's still a question that people ask all the time. I'm in the business. I don't have an ARM. That's because I got a very good 30-year fixed. And surprisingly, Gordon, what percentage of people have a 30-year fixed rate below 3% of owners today?
If I was a betting man, I'd probably say about 27%.
You're very close to 24%.
Okay.
According to Black Knight,
Okay.
Black Knight Financial, they do a survey on that. So there's still a lot of people who could get below 3%, but now rates are at 3.11%. The chances are starting to fade a little bit more as we see these interest rates rise. Inflation is going to be a key player in 2022. How is that going to play out, Gordon? In your mind, you're a big real estate investor. You're always looking at opportunities. Is this something that you're going to just kind of sit back and see how it plays out? You're not sitting on the fence like a lot of buyers, and we are going to get into that because what is the right time to start looking at houses? Is there going to be more inventory? But as a current investor, do you sit back a little bit and wait for it to start seeing what happens?
I've been around the block enough, so I've always looked to hold the line. Especially, I always tell people, I'm a stock investor, and when the market starts to go topsy-turvy sideways, I look the other way, because by me pressing on, make a lot of bad decisions, especially if you look at the history of the market over the last 12 to 18 months, everything has been temporary. So a lot of times as the market starts tanking, unless I'm in a margin position, I have a margin call, I have to sell something, be able to cover my costs or my leverage, I tend to look away and just kind of let the market kind of correct itself. If you ask me about inflation, I kind of feel the same way. Inflation is like everything else. It comes and it goes. I think it's not a hot button, the hot topic for the last 3 to 4 months, as everybody's talking about it. More people talk about it, the market kind of reacts. But if you look at the long-term goals, I think we've got a good economy. So I think a good economy, low unemployment numbers, a lot of things that actually can change the direction of the inflation woes and talks that are coming now within the next 3 to 6 months. So at this point in time, I'm not too concerned to give you a direct answer.
What do you hear when you hear this answer to the survey? What do you think? In 2022, investors think gains will be much lower after seeing the S&P rally over 27% this year to record highs, saying that there's going to be headwinds to worry about. Inflation is at the highest level in decades. Supply chain problems seem to be insoluble. And if these issues continue worse, they could derail the recovery. In inflationary issues like now, we add COVID into all of that, and we see higher interest rates. We see inflation around the corner. Actually, it's here. Do people start going into real estate? Is that another push towards real estate? Looking at low fixed rates, has that been something that kind of subliminally people have been doing, and saying that's why I'm going into real estate. That's why I'm willing to offer over asking price. That's why there's not a lot of sellers, because they're sitting on good interest rates right now. Is that something that investors look at, and why it continues to push up home prices?
Well, typically, Wall Street investors, typically when high inflation, they go towards more of the fixed income assets. They look at gold, they look at the precious metals, they look at those type of things, they look at the commodities. Real estate, it's kind of really hard to say, because we've been such in a real estate run over the last 8 to 10 years that you have to go back and take the last 30 or 40 years into consideration to come up with a consensus answer. Because if you use the market indicators now, you would see that real estate, probably everyone has gone that route, but it's not because of inflation. It's just a sign of the times. The real estate in the last 10 years has been the hottest product on the market, especially the last 3 or 4. So a lot of times there's been a lot of high numbers in there that you have to factor out to come to a real clear decision for a long haul based upon your investment strategy.
I think that equates out to the average investor, the average real estate investor, and that could be anybody buying and selling homes or somebody just buying a house to live in. That might be a confusing time for people, not knowing where COVID's going to end up, not knowing how the economy is going to react to COVID and any kind of so-called recovery that we might see, as well as, again, how the Fed is going to react and how the stock market is going to react. I think it's going to be a very confusing time for 2022. As long as we can, we're a real estate show, so we're going to focus on real estate, but we're still real people. We're, just like the Hair Club, we're users too. We're members. So we're paying close attention to what's happening in real estate. If you have any questions, you're welcome to call the show, 800-516-1220, 800-516-1220, or you can email us, Tony or Gordon, at bayarealoansource.com. We'll be right back after this break here on AM 1220 KDOW.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Thanks for joining us today. You're always welcome to call the show, 800-516-1220, 800-516-1220. Just kind of finished talking about inflation in the last segment. 3/4, this will kind of addition to that segment, 3/4 of home buyers and sellers report changing their plans due to inflation, according to Redfin's survey. They're saying 10% are canceling 11% are canceling their plans altogether. Meanwhile, 10% of respondents say inflation is causing them to move up their plans to sell, and 7% are delaying their plans, and 3% are just canceling. So inflation is going to play a part in this, but in conjunction with that, you have to look at what inventory and supply and demand. Inventory is down 3.3% week over week, and it's 58% down from 2 years ago, and 27% down year over year. And you're looking at just anemic amounts of inventory across the United States, and especially in places where people are wanting to move. I just sold a house in Richmond, Virginia. It was sad to see that 4 or 5 months later, it's the hottest market in the United States as far as bidding wars. You never know. But that's where people are moving. It's going to be even hotter in those places where people want to move. That's just kind of the nature of the game. But you see these surveys and you say, okay, there's people who are going to make a decision about inflation, whether or not they're going to buy or sell, yet inventory is so low. There's plenty of buyers that are positioned to buy your houses. It's all about inventory right now. We don't see it coming back anytime soon.
Well, I think timing is key, of course. Everybody likes to, as we talk on the show all the time, is everybody wants to use the great predictor, the crystal ball. I think, but timing is key to any decision that we make or don't make. Deciding to sell a property, I think you have to have a plan. You just don't up and sell. You got to figure out where you're going to move to. where you're going to move that money to. There's a whole lot of things that go into selling properties, tax ramifications of having to, pay taxes. A lot of times people don't account for taxes when they sell something. When you have a rental property, you can sell a rental property at a loss and still have a capital gain simply because you have to go back and recapture all the depreciation you took over the years. That's all now taxable. So a lot of different things go into play. And I think before you make what they call a knee-jerk reaction, decide to sell, we always recommend sit down and talk to the professional, not Cousin Vinny, of course. Talk to your CPA, talk to your enroll agent, talk to your accountant, whoever does your taxes, and kind of make sure that selling is going to benefit you from a tax standpoint. Taxes is a big part of anything that we do, especially now as we come to the end of the year. Taxes on everybody's mind. You have to make sure you satisfy your uncle, because if you don't, you can put yourself at arm's risk as far as taxes are concerned.
Well, it's definitely one of the things I would think about when holding real estate. But for the buyers, Gordon, looking at this, it's kind of self-serving in a way. It's like, okay, so there's not a lot of inventory. I'm going to have trouble buying a house. But if I get into a house, I'm looking at possible, decent returns. According to Case-Shiller, they're expecting a slowdown, definitely, but they're still looking at about 7% on average. Places like Phoenix, they've seen 29 consecutive months in first place at 32% increase year over year. Tampa and Miami kind of sit behind, but 6 of the 20 cities, they reported higher price increases year over year, October 21st, compared to the previous year or previous month, that is. So we're still seeing places, large cities across the United States, going up because of the demand. Is that kind of an incentive? Okay, so it's hard for me to buy a house, and yet I might have to go over asking. I probably have to go over asking, but yet we're going to see some returns on that. But are these the same people who are buying a house that are looking for returns? Or are they just trying to buy a house? That's the tough one that I haven't quite figured out yet.
Well, also it's true. You have to look at the formula. If you sell in a hot market and you're looking to buy, you're going to buy in a hot market. So a lot of times all that gain that you made on the sale of your property, you're going to put a lot of that gain back into the property you're purchasing, especially you have to come in over asking. So a lot of times, once again, timing is crucial. Now, of course, if you can actually sell and hold and wait till the market, ciphers or tones down and get more bang for your buck, that's probably the best position to be in. But when is that going to actually take place? So once again, you have to strategize. You have to understand your motive for what you do, especially from a taxation standpoint, income standpoint, long-term benefit to your family, and make those decisions based on those, not because of everybody selling in the marketplace because the prices are high.
Short-term as well, you see it right there on the horizon. It's interest rates are going to go up eventually, and that you see home prices are going to go up as well. But a lot more people are saying, I want that lower interest rate, even though the home prices are higher, because it would cost you more with a lower priced home with a higher interest rate. Some people are making that calculation, saying that's why we want to get in. Plus, we start getting our tax advantages as on a monthly or yearly basis as an owner on your Schedule A immediately. And a lot of people and then we have rents that are rising. So you have these renters that have been sitting back trying to save money, watching their rents go up. We've seen, if you go and look at it, I don't have the chart in front of me, but it goes steady, kind of slow, nice, moderate rise, and then all of a sudden, boom. Once when the pandemic hit, boom, it starts going straight up. So we're seeing double-digit year-over-year increases in rents. There is no slowdown in sight, and that's also another incentive. So I see that playing out even as interest rates stay moderate. They think 3.6%. They meaning the economists. You have Wells Fargo, you have Fannie Mae, Freddie Mac, you have the FHFA, you have Mortgage Bankers Association. All of these other surveys, it's averaging around 3.6 is where they think the average will be in 2022. That's still a very good interest rate. I say that interest rate is not high enough for people to slow it down. It's going to slow down, though. We know that. As far as sales, we're going to see home prices year-over-year increases slow down, but I don't think that's enough to really put a dent in how hard it's going to be to buy a house, and I think that's what it comes down to.
Yeah, I mean, it comes down to a lot of different things. Once again, the economic indicators are out there as far as what the market has done. Keep in mind, all the decisions that we make are based on past performances, but of course, the great, cliche is past performance does not guarantee future benefits because it's in the past. So a lot of times you have to really, really sit down and look at all the information to come up with a consensus of what you would do. You might be right or you might not be right, but you just got to percentage wise put yourself in a winning position and just make that qualified decision.
The price to rent ratio is something that affordability is what it comes down to. One of the things that they follow is what they call the price to rent ratio. With inflation, I was very surprised to see this. That we're back to October 2004 levels of real home price and price to rent ratios. I was surprised to see that. Actually, it's 2006. January 2006 is where it compares to where we are today. We're actually lower if you compare it to the, I believe the Case-Shiller Composite 20 MSA. So affordability is also something that people are paying attention to. Now, with the lack of inventory to choose from, the abundance of buyers, and then you have affordability and higher interest rates really kind of playing against each other and higher home prices, I still think it's a time to buy and get into real estate because of whether it's about necessity or not. I think that there's still a really then you have the stock market. Who knows what's going to happen with that? With inflation, we could see some dips here and there. Is it a safer place? Where are the better returns? I think we see more people coming out of the stock market going into real estate because it's a stronger asset during inflation.
So the qualifying question is real estate the best place to shelter your income in case of inflation?
That's to be seen, I suppose.
To be determined.
To be determined. That's not for us to decide or guess on, but it will happen. We'll come back after this break. You're always welcome to call the show, 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. We'll be right back after this break on AM 1220 KDOW.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You always call the show, 800-516-1220. Get your questions on the air. That's 800-516-1220. Were you going to say something? You look like you were going to say something.
I got distracted from a text. A customer just texted me on something, wants to know if I can talk on the radio about it. So I thought that was interesting. I will.
Okay. Would you formulate the...
Yeah, I just got to formulate her. I guess got to formulate her question, basically.
Okay. We're not getting too distracted. Yeah. Homeowners are sitting on the record amount of equity. So how do you pull cash out? A record $9.4 trillion in tappable equity, according to Black Knight, collectively, of course, or an average of $170,000 per owner. How do you take cash out as interest rates are kind of creeping up? Do you pull the trigger now before they do? Do you sacrifice giving up your sub 3% interest rate or even something in the low threes to get something the same to get cash out while you can? A lot of people are afraid what's going to happen with the economy. Maybe I'm not pulling money out and putting in the stock market, but a lot of I don't want to call them analysts, but professionals would say, when you take cash out of your house and you're not going to use it to buy something or improve your property, make sure you're at least earning some interest on it, some sort of return on your investment. But I'm not looking to go in the stock market. Would you look at pulling out cash now, Gordon, or would you like to see it play out a little bit? And I think I'd like to. I don't know if I'd want a HELOC, but if it comes down to like emergency funds. And that's what I'm afraid of, maybe running out of money or having to run up a credit card and not pay, or a school or something like that. I might go for a HELOC and just kind of keep an equity line, that is, and keep that open just in case of emergencies. I know you're kind of a proponent behind equity lines for emergency reasons.
Well, the one place you don't want to pull cash out and put it in the bank, you actually be losing money based on what's inflationary words, of course, the value of your money. If you look at the kind of rate of return you're actually going to get for that money being in the bank. And of course, once again, stock market always sounds good because right now stock market is operating in the high end. Real estate, everything sounds good that's operating the high side. I think when there's turbulence, I think that's when you start to question your decision making. But if you want to know, should I take cash out now or should I wait? Once again, forget the crystal ball. As we always say on the show, if the rate and the number works for you, then you should pull the trigger. So rather it's 3% or 2.5%, if that number works for you, that takes what we call the greed factor out of it. pull the trigger.
Well,
You know,
let me refine my question then.
That's what I always tell people.
Let me refine my question. Let's say you are going to eventually pull cash out. You have a plan to use the money in 2022. Let's say it's 7 months from now. Do you do it now, or do you risk the interest rates going up higher? But you're not going to use the money, so you're not going to be making. You're going to be making payments on it for 7 months. Yeah, the rate might be lower, but you're paying 7 months worth when you don't need it. So what's the answer there?
Well, once again, I'm assuming you're not going to pull cash out of your house and push your payment higher. So a lot of times, most people right now, most clients are pulling cash out and keeping the payment the same. So actually, their debt to income ratio or monthly exposure is the same. A lot of different things, a lot of different features and benefits you have.
That
to
I
look
might
at.
consider.
And then
Maybe
you have to
re-amortizing. Maybe keep the same rate. Re-amortize, keep my payment the same. See how much cash I can get. Those are easy numbers, Ron. You're always welcome to run those by us. Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. You can always call the show, 800-516-1220. I'm Tony Mendez. That's Gordon Hines. This is a real estate report. We'll be right back after this break on AM 1220 KDOW.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
And this will be our year. Took a long time to come.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Happy New Year to everybody. Feels like one long 2 years, doesn't it?
Well, I mean,
2021, 20 and 21. Just one long year.
yeah, because it seems like we're revisiting the problem we had a year ago that we thought was solved. And, of course, it never got solved, but we assume it was solved. And the guards came down, the mask came off, and now we're going back to the same thing. So a lot of people you talk to them are frustrated with wearing the mask and frustrated with this current situation. But regardless of how frustrated you are, it's not a solution. So we have to continue to work towards a solution and just kind of participate in the plan.
Some of the things that are going to change in 2022, mortgage rates are going to do what they do. But the Federal Housing Finance Agency, they announced their new conforming limits for 2022. Their baseline conforming limit is going to be $647,000. That's another $98,000, basically $100,000 higher than it is today. And they're already taking applications for that, by the way. So you can take advantage of that new limit. There's a lot of advantages of falling into that conforming limit, including rate, guidelines, cash out limits, and lower credit scores. There are so many things that you were surprised when I told you today. You asked me to price something out, and I said, oh yeah, you can have a 640 credit score and take cash out up to, and this is what they call the high balance limit, $970,800, up to 80% on your primary with a 640 score.
Yeah.
So there's a lot of advantages falling either into this baseline conforming amount or the high cost areas, which most people who are listening are in the Bay Area counties, is $970,800. Now for a 2-unit, that went over 1.2. That used to be 8 something. And it's so I know you say it'd be great if they would take zip codes in every county instead of just tagging it to a whole county, because we know that people out in Solano and Napa, they don't quite have the same limits they do in Alameda or Contra Costa or Marin, but there are certainly houses that would qualify in loan amounts, and they just don't quite fit. But now that they've adjusted it, it should help a lot of people. That's something we're looking forward to, so that you can get these interest rates that Fannie Mae and Freddie Mac offer. Right now, Freddie Mac offers the 30-year fixed at 3.11% on average. Make sure I say that, on average. And you can look that up at Freddie Mac PMMS, Primary Mortgage Market Survey. And that's always a great way to follow what rates are doing. And a little bit of news there as well. But going back to these loan limits, that also FHA also increased their loan limits across the United States. It's not quite as high as the conforming loans by Fannie Mae and Freddie Mac, but it still helps. All of these things help people get homes. And then we have the addition of some of the new products coming with non-qualified mortgages, which continue to kind of trickle in and help people throughout the United States and get in and out of properties. And anything you want to add to that? Anything else? Oh, the credit score average is coming out. So if you have one borrower that's a 700 and one borrower that's a 800, your average score is 750, and that's what they're using. So, all of a sudden, they're not using the lower credit score to price your loan out. They're using the
What they call blended score.
blended score, which will give you the better pricing. I'd like to see that translate into jumbo eventually, but there are jumbo products that are following Fannie Mae and Freddie Mac guidelines. So we just talked about how it's great to fall into those guidelines. There are now jumbo products offered by very few lenders, which by the way we use, that offer jumbo loans following Fannie Mae guidelines. And that includes things like the asset depletion, higher limits where you don't have to be of 62 years old and retired age to get mandatory withdrawals. You can be less than that and use full assets. I mean, there's so many things that fall into using Fannie Mae, Freddie Mac, and FHA that I believe are improving. We're going to see that really play out in 2022.
Well, one of the things that I think is important, as we talk on the show all the time, is not all products and not all lenders are the same. You know, I got a call from a client today. They were in contract to buy a property. They said, I said, well, why you didn't call me before? They said, well, the specific person that wrote the contract had the lender for us and told us if they use the lender, we're going to get our contract accepted, which of course is illegal. I think that's called steering. But needless to say, that's not my fight. But at this juncture of the game, they're supposed to close the first week in January. Come to find out that the property that they're living in, they're going to be departing from that property to buy another property. This particular lender on a jumbo product is telling them they cannot use departing rents. They have to use a 24-month average of rents if they are going to use the rents to qualify. And of course, they don't have 24 months average of rents. It is a duplex, and the property was not rented in 2019. It was renovated. So by the time they took a 2019 huge loss on their tax returns plus the 2020 profit, it actually comes out to be a loss. So of course now they shot themselves in the foot by not coming to me in the first place. So I figured I checked with our guidelines, and one of the products that we have would only take the last year's rental into consideration. So we won't go back to 2019 where they had the loss. We'd only use the 2020 in which there was a gain or a profit. So once I factored and ran those numbers, I actually got them to qualify. So right now I'm in the process of getting that appraisal transferred to me, and we'll be able to do a successful closing for that specific client. So a lot of times there's these things, I understand where they're coming from. They wanted a house real bad, and of course the person writing the contract gave them some, inaccurate information to get them to coincide to do what they wanted to do. And at the end of the day, the deal still is not closing regardless of, any sneaky.
That's really important that you mentioned that.
And now I'm here, I'm going to get the deal to close. Of course, we won't be closed in the first week of January. We'll need an extension. But needless to say, these things do happen. That's why not all lenders are the same, because one lender doesn't do it. That doesn't mean another lender to do it. All comes down to guidelines and underwriting.
I think it's interesting. All of that's interesting. But the one thing that I kind of got out of that is that a lot of these recommendations for using lenders are coming from realtors too. And they've got to keep up. You know it. You got to keep up with what's working and what's not with your lender. If it's that lender that's not keeping up with the times, in this case, that one just isn't. Their guidelines are too tight. They need to revamp their whole system. You're not doing your clients a service. You're just, I don't know, are you getting kickbacks? I don't know. You're not allowed to, but find a new lender. We do these all the time. But speaking of this, kind of segued right into the email that we got from Raj. He's in the East Bay, about how different lenders are. Raj says he wants to refinance his loan on his primary residence. He's salaried and has a small business that's been affected by COVID and is losing money for the last 2 years. He says, my current lender said I cannot refinance because that loss on that secondary business, the self-employed business, is counted against my income and I do not qualify. What options do I have here? Tax season's coming up around the corner as well. So this is a very good example of what the differences are between one lender and another. Indeed, he does not have to use his losses from his business. What happened is the loan agent probably submitted the tax return that he didn't need, and that tax return showed a loss. Even if he did show the tax return, the lender should not take the loss because they're not using the income. It's funny. If you're losing money but you don't use the income, you don't need to use that against you don't need to use it. So it's like it's not even there. They put blinders on. So this is a perfect case of how, and we just did one like this, where one lender will ignore it and the other one won't. So that's the unfortunate downside to not knowing which lenders out there, and that's why brokers are picking up more and more business, because they will eventually find a home for this loan because they use multiple lenders like we do. Anyway, we'll come back after this break. You're always welcome to chime in, 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. We'll be right back. This is the Real Estate Report on AM 1220 KDOW.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back in to the Real Estate Report. I'm Tony Mendez.
And I'm the maestro, Gordon Hines.
Happy New Year. Hopefully your party sounds a little bit better than this one.
That's more like winding it down in life.
Oh, wow. Look at this. Richmond, Virginia tops the list. And I just sold a house there. I kind of wish I kept it for a couple more months, but it was starting to leak money. Share of Redfin offers that faced bidding wars in November of 2021 was Richmond, Virginia. Other cities that made the list, second was Salt Lake City, San Diego, Honolulu, Dallas, Nashville, San Jose, San Francisco, metropolitan area, Sacramento, Seattle. A lot of these are all in the West. But overall, 59.5% of Redfin homes offers facing bidding wars in November. That's the first time it's been below 60% since December of 2020. I don't see that as a big piece of news because we still are seeing multiple offers as well as over asking. I don't see that as any kind of indicator of what's going to happen in 2022 as far as more inventory hitting the market. But days on the market is something that we do want to pay attention to. One of the kind of surveys we looked at recently discussed how days in the market is an indicator on not only if you should sell, but if you or to buy, but if you should sell. I kind of screwed up the punchline on that. Not only if you're buying, but also if you're selling. Do you agree with that as a seller? Should you look at days on the market and go, oh, now that similar home is now on the market for 30 days instead of 20 days. Now it's 45 days. Is that something as a seller you might consider looking at?
Well, absolutely. We talk about that all the time. Days on the market is one of the leading economic indicators to where values are going. If you're seeing days, you see a property listed, average list day right now is about 21 days on the marketplace. You, as a seller, you're seeing houses on the market 45, 60 days, and the first thing comes to mind, you start to see the price reductions, reprice, new price, as we put in the MLS. And once you start to see that new price is not going to be higher, it's going to be lower. So therefore, you know that the economic engine of the property you're trying to sell, the gas is going to run out pretty soon. So as a seller, these are the things you want to be mindful of when you're looking at a strategy of when you should put your house in the market. Days in the market is one of the best indicators.
Realtor in Florida said, for sellers, a rising number of days on the market should be a trigger for you to sell while the prices are still peaking. For buyers, if you see a trend in rising days on the market across the area, then be patient. For sellers, this means that your buyer pool will begin to shrink and there'll be less demand in the market once interest rates begin to climb. And this should lead towards lower overall prices due to less negotiation power for sellers at a higher supply And he said, if you finance your loan, then your mortgage may end up at a higher monthly payment on a lower priced home. This is a major factor in why many people are willing to buy at record priced homes at low interest rates. Now, I agree with that one. Do you agree with the other two?
I do. I think he just said what I basically said. He stole my line.
He said it first.
Okay. I might get him for copyright infringement. So I was thinking about it first. But needless to say, I do agree. Days on the market is a key indicator. As a matter of fact, a client of mine, an old friend of mine, he's a corrections officer, retired, out of New York City, living in what the place called the Poconos, which is in Pennsylvania. He bought a house there like 10 years ago.
Good skiing there, by the way.
Find a place to live. Now he's seeing the economics of the neighborhood change and a lot of new homes, which is he figures going to affect his value. He's looking for, should I sell now, even though he's not ready yet? His wife's got another 3 or 4 years in the workforce. And I said, listen, if you're seeing what you're seeing, a lot of more properties come on the market, you might need to sell now and move to someplace else rather than losing that equitable position you have or minimizing it by holding on to property longer. So it's decision making is one of the key things in life. You have to make the right decision and you have to use the right information to come to the right decision instead of just throwing things in a hat and plucking one out. Should I sell or should I buy? I think these are the things that you have to look at if you are an astute investor. There's no reason why you shouldn't, because the information is out there for you right at the fingertips.
Well, I can tell you, like, for example, I sold in Richmond. I got a text from somebody, a regular listener that we did transaction for many years ago, and he said, "What do you mean you were leaking money on your house? Why'd you sell if Richmond, Virginia was doing so well and you knew it was doing it?" That's my case was a little bit different because I had an inferior home and it would never had priced as well as the superior homes, but because of the lack of inventory, it was pricing out the same. I'll make it simple. Brick homes and a vinyl home were now pricing out the same. That's why I sold back then, earlier in the year, and it did great. But it was leaking money because too many expenses and the tenants were horrible. So it was kind of the perfect scenario for us to sell. But that was an easy decision, I believe. It doesn't get that easy for everybody, Gordon. But looking back at decisions, some people, they want to have that hindsight, right? They want that hindsight to say, I did the right thing. I did the right thing. And some people just sit back and they never do anything. My dad always said the man who makes no mistakes usually makes nothing at all. This is the biggest mistake or the biggest success that you could make. So
people like for their decision to be, verified or second, as we say. It's like in the anybody second it. That's what they like to hear. So whatever decision they make, they'll tell you, well, Tony, here's why I sold. I did the right decision tonight, and that's what they want to validate.
They're always going to say they did the right thing.
So, but at the end of the day, once again, only time will tell if you made the right decision. Correct?
I wish I didn't buy that car I bought, though. I'll be honest with you. I'm not gonna say it was the right car. Anyway, I won't tell you what that is. We'll come back next week. Thanks for joining us. We'll come back next year. I've always wanted to say that. We'll see you next year. I'm Tony Mendez. That's Gordon Hines. You're always welcome to shoot us an email, Tony or Gordon at BayAreaLoanSource.com. Tony or Gordon at BayAreaLoanSource.com. Thanks for joining us. I'm Tony Mendez. That's Gordon Hines. This is the Real Estate Report on AM 1220 KDOW.